What if I told you that two people could start with the exact same amount of money, invested over 20 years, make incredibly smart decisions along the way, and still end up living completely different lives? Welcome to this explainer. Today we're tackling the absolute ultimate financial debate: real estate versus stocks. Seriously, for decades, investors have been fiercely arguing over which path creates more long-term wealth. You've got the real estate folks swearing by rental income, leverage, and property appreciation, and then on the flip side, stock investors are championing diversification, compound growth, and just the beauty of simplicity. And you know what? Both sides claim they're absolutely right. But instead of just relying on opinions or getting lost in internet debates, we're going to go strictly by the numbers. We're walking through a purely mathematical breakdown to demystify once and for all which path actually builds more wealth over a 2-decade timeline.
So, to answer this massive question, we've got to set up a totally fair apples-to-apples comparison. We're going to bring in two highly disciplined individuals. Now, they are both starting with the exact same initial capital, $60,000. They both have a strict 20-year time horizon, they're both super patient, and they both want to build serious, life-changing wealth. But here's the catch. They are about to take two radically different paths to get there. Let's see exactly what happens when the starting line is identical, but the strategies are just worlds apart.
All right, meet Jake and Marcus. Jake firmly believes that real estate is literally the absolute best path to wealth, so he takes his hard-earned 60 grand and decides to pour it straight into a rental property. He just loves the idea of owning a physical asset, something he can actually see and touch. Then, right next to him, we have Marcus. Marcus takes his $60,000, but instead of dealing with property, he funnels it straight into a low-cost S&P 500 index fund. His whole goal is long-term investing with absolutely zero tenants, zero property management, and definitely no midnight repair calls. They both share that rock-solid 20-year mindset. So, who wins? Let's run the math. Okay, let's dive into this. Let's look at Jake's real estate move first. He doesn't just buy a $60,000 asset. Oh no, he uses that money as a 20% down payment. Financed with a mortgage, Jake is suddenly controlling a massive $300,000 physical asset right out of the gate. And honestly, this is the core mechanical advantage of his entire strategy. That magic right there, that's leverage. Instead of controlling only his original 60 grand, Jake is controlling a $300,000 property using the bank's money. It's a game changer. Assuming a totally reasonable, let's say 4% annual appreciation rate, that property's value after 20 years grows to roughly $657,000. I mean, that is a seriously impressive number, and it's unlocked entirely because he leveraged up right at the starting line. But hey, appreciation isn't the whole story, right? There's also cash flow. Let's break it down. Step 1. Jake collects an assumed $2,000 in monthly rent. Step 2. He's got to deduct property taxes, insurance, maintenance, and management fees. Step 3. Jake pockets an average of about $500 in pure, positive cash flow every single month. Over our 20-year timeline, that generates roughly $120,000 in extra income. And honestly, the absolute best part of this whole setup? His tenants are quietly paying down his mortgage every single month. They are literally building his equity for him.
So the crucial point is, on paper at least, Jake looks like an absolute financial genius. But let's bring things back to reality for a second. Real estate is not passive. To get that sweet cash flow, Jake is out there dealing with new roofs, surprise water damage, months where the property sits vacant, bad tenants, and of course those dreaded 3 a.m., hey, my toilet is overflowing phone calls. Your time has value, your stress has value, and over 2 full decades, let me tell you, those hidden costs absolutely add up.
All right, now let's shift gears and look at Marcus. He takes his initial $60,000 investment, parks it in an S&P 500 index fund, and just to perfectly match Jake's cash flow from the rental, Marcus makes consistent $500 monthly contributions to his portfolio. The major glaring difference here? Marcus has absolutely zero tenant complaints. No broken toilets, no messy evictions, no sudden property tax hikes. His strategy is 100% passive. Now, to run Marcus's numbers fairly, we definitely need a realistic growth rate. Historically, the U.S. stock market returns roughly 10% annually, right? That's before inflation. But just to keep our projections super conservative and to really test if stocks can hold their own against leveraged real estate, we're going to use an 8% annual return for his mathematical model.
And this brilliantly illustrates the true engine of stock investing: compound growth. It's like a snowball rolling down a hill. In that first decade, the growth curve looks, well, kind of flat. It's slow. But the second decade, that is where exponential compounding just kicks into overdrive. It's exactly why legendary investors like Warren Buffett accumulated the vast majority of their explosive wealth much later in life. Compounding demands patience, for sure, but it rewards it exponentially.
Now, we absolutely can't talk about these paths without addressing the elephant in the room, risk. Specifically, the double-edged sword of Jake's leverage. Look, if asset values rise, leverage gives Jake massive, amplified gains. It's fantastic. But imagine a severe housing downturn where property values drop, say, 20%. Because Jake owes the banks so much money, his equity could disappear rapidly. He might even go completely underwater. Marcus, however, he simply sees his unleveraged portfolio dip by exactly 20%. No more, no less. Leverage amplifies the opportunity, but man, it really amplifies the risk too.
Which brings us perfectly to Marcus's built-in protection mechanism, diversification. By owning an S&P 500 index fund, Marcus essentially owns tiny pieces of hundreds of different companies across multiple sectors. We're talking technology, healthcare, consumer goods, financials, industrials, the whole shebang. If one sector completely tanks, Marcus's portfolio survives. Now contrast this broad safety net against Jake. Jake holds highly concentrated risk in one single property, in one specific local market. If that single neighborhood declines, his entire investment takes a massive hit.
And then, there's a huge cost that never, ever shows up on a balance sheet, your time. Think about it. Over 20 years, Jake literally spends cumulative months of his life managing repairs, hunting for tenants, reviewing contracts, and coordinating maintenance. And Marcus? He spends maybe 15 minutes a month casually checking his accounts on his phone. It really raises a fascinating philosophical point, doesn't it? A dollar earned totally passively through stocks holds a very different lifestyle value than a dollar earned through the active, hands-on stress of real estate.
So we've looked at the mechanics. We've talked about leverage, cash flow, compound interest, diversification, and the actual value of a person's time. The tension has been building for 20 simulated years now. The starting line was exactly the same. Both investors stayed the course and didn't panic. So, mathematically speaking, when the dust finally settles after 2 entire decades, who actually wins? What's your prediction?
Now, what's really interesting about this slide is the grand reveal. The numbers are shockingly close. Jake's appreciated property, his paid-down mortgage, and all that monthly cash flow bring his total net worth to over $700,000. Amazing. Marcus, utilizing disciplined, patient compounding, sees his portfolio exceed $800,000. So yeah, Marcus edged out a mathematical victory, based on our conservative assumptions today. But the real, undeniable takeaway here? Both paths worked phenomenally well. Both of these guys successfully became wealthy.
Because the core differences in their journey weren't really about one guy being completely right and the other guy being completely wrong. It was simply about the tools they decided to use. Jake relied on real estate, using leverage and cash flow as his wealth engine. Marcus used stocks, relying on broad diversification and compounding. They utilized completely different mechanics, and they lived totally different daily lives, only to arrive at a nearly identical, highly successful destination. And that brings us to the ultimate philosophical twist of this entire explainer, a truth that might honestly disappoint anyone looking for a simple, tribal, black and white answer. The biggest mistake isn't choosing one path over the other, not at all. The biggest mistake is never investing in the first place. In the real world, you'll find that many millionaires actually use both asset classes. They utilize stocks for that passive, hands-off growth and peace of mind, and they use real estate for the incredible power of leverage and monthly cash flow.
So, instead of wasting time arguing over which asset is objectively better, the focus really needs to turn back to you. Which strategy actually matches your personality? Ask yourself, do you actually enjoy managing physical assets, getting your hands dirty and hunting for deals? Or do you fiercely prefer the simplicity of pure automation? Can your stomach handle the risks of massive leverage during an economic downturn? Or do you sleep much sounder at night knowing your wealth is safely diversified across the globe? Because ultimately, the golden rule of wealth creation is this: consistency beats perfection. Every single time. Endless debate over finding the absolutely perfect asset class usually just leads to analysis paralysis, and you end up doing nothing. Staying invested month after month, decade after decade, that is infinitely more important than stressing over picking the perfect starting vehicle. Wealth isn't about getting rich quickly. It's about making smart, mathematically sound decisions and then repeating them over a very, very long time horizon.
And that leaves us with one final provocative thought to wrap up our explainer today. You've seen the math, you understand the hidden stressful costs of real estate and the slow burn patience required for stocks. You know that both paths will lead to tremendous wealth if you just stay the course. So, looking ahead right now, which path will you consistently stick with for the next 20 years? Make your choice and just start building. Thanks so much for joining me today. I'll catch you in the next explainer.